Welcome, everyone. We'll wait just a few seconds here to let everyone join, and then we'll begin. All right, looks like we can get started. Welcome to the Healthcare Lounge. Today's topic is all captives are not alike. And I will now turn it over to Nelson Griswold and Phil Holowka.
Thank you, Kendall. Welcome to this episode of the Healthcare Lounge. I'm Nelson Griswold, and it is my pleasure to welcome to the Healthcare Lounge our guest for today, Phil Holowka, who is the captive manager with Ultimate Captive. He runs the Complete Captive Management Services company and is a 14-year veteran of managing captives. So I figure that he's going to be finally getting it down in the next couple of years. Phil, welcome to the Healthcare Lounge.
Well, thank you, Nelson. Thanks for allowing me to sit into this conversation with you.
So Phil is on the road and is has a bit of a road trip, and so has taken a break from the travels to spend some time with us. So what I want to emphasize to everybody today is this is not just a conversation about captives. This is an opportunity to dive into what it's like to manage a captive for ultimate results, for optimal results for the employer client. And more to the point, what has Phil seen from his very unique vantage point as a captive manager that I don't see, you don't see, from our perspective or our vantage point, as in my case, I'm leading a movement and I'm running the Next Gen Benefits organization, Next Gen Benefits Network, or you as an advisor or broker in the marketplace. Our perspective is completely different. Our vantage point is completely different than Phil's. So I want to, first of all, we want to talk about just sort of a general take on captives, Phil, in your experience, how you got into captives. I think would be interesting to hear, and then we'll move on from there. So welcome, and give us a sense of how this all came about.
Oh boy, so I was a paramedic for 20 some years, and then I served as the executive director of an ambulance association. And those association members wanted to have more controls over the purchasing of employee benefits. And at the time, there was an existing property casualty captive that was very successful. So they simply said, hey, can we do this for our own members? And can we make it employee benefits? So I was charged with that task. And 15 years later, here I am running MedTrans Insurance.
And for those of you who aren't familiar, MedTrans is the platform on which we've built the Ultimate Captive, the Next Gen Benefits Ultimate Captive. All right, so Phil, there is a sense that all captives are the same. It's just a different flavor from, and some of the well-known ones in our space are Berkeley, Pareto, Roundstone, and there are quite a few others. And they all actually are a bit of the same with just a little bit of different flavors. The MedTrans Captive, the Ultimate Captives Foundation, is different. Can you talk about the two different types of captives in the marketplace?
Yeah, so what you speak of is there's one silo that you have to go down, and it's an ownership silo. That silo talks about or has in discussion a group captive, which could be owned by multiple entities. And then there's a single parent captive where the employer is the sole owner of that captive. So you have to look at the ownership structure through one set of, one lens. And then you have to look at what's called a reinsurance captive or a direct writer captive. Now, most of the medical stop loss group captives that are out there today are reinsurance captives, which means there is a commercial admitted stop loss carrier that is issuing the policies to the client, and then the captive reinsures that commercial policy that was issued by the admitted carrier. So the model that Ultimate Captive is in one of our flagship captive, we are a direct writer of medical stop loss policies, which translates into we do not have a fronting carrier. So that allows our structure to have more controls and efficiencies that ultimately the employer benefits from.
All right. So is it fair, and I've had conversations about this, it's fair to say that the group captives, which are also referred to as rent-a-captive, because you don't own, and the employer doesn't own anything, they're literally renting a room in a hotel, versus the single parent captive, which is like buying a condo in a condo building. So you're part of a greater whole, a bigger whole in terms of the overall captive structure, but you're buying the condo or your own insurance company in a single parent captive, as opposed to simply renting space, renting a room in the group captive. Is that fair?
That is fair. It's all about ownership and controls. When our captive first launched, it was a group captive. It was owned by the members, but we were reinsuring a commercial carrier's policy. In that structure, we felt it was the tail wagging the dog. The admitted carrier was doing all of the things that our members wanted more controls over. Therefore, we re-chassied our captive structure to what it is today. Every employer owns their own single parent captive, which means it's that they own the captive. It's like buying a condominium, because you're going to be paying stop loss premiums into your own condominium, which ultimately boils down to an asset that you're building for the employer.
All right. So just to be clear, in a single parent captive, an employer, the client, so these advisors who are with us today, their client, their employer client, would set up a separate corporation, wholly owned subsidiary that is an insurance company. And the purpose of that insurance company is to manage the risks, in this case, the medical risk, the healthcare risks of that company. Right?
That's right. Yes.
Okay. As opposed to simply renting space in a group captive where there is much less control and, as we're going to talk in just a second, a lot more overhead.
That's right. Yes.
Okay. So let's talk about the advantages, the pros and cons of both models. So the group captive, what are some of the pros of a group captive? Why might an employer be looking at a group captive?
Well, I think there's, to some degree, it's an easier entry point for an employer to join an existing captive and really hand off all of the duties to an admitted carrier. Because at the end of the day, the group captive does not issue the policy. They don't underwrite the policy. They don't collect the premiums. They're offloading those duties to a commercial carrier. And that's perfectly fine. So the ease of entry to that is what it is. But remember, if I'm a shareholder of that commercial carrier, I still want that policy that is issued to yield a return on shareholder investment. So therefore, it's pretty expensive for a participant in a group captive to have an admitted carrier issue that policy, as compared to the single parent captive issuing that policy direct.
All right. So a Pareto or a Roundstone captive is not underwriting the risk. There's a
Correct. It's the carrier is.
okay, and so a carrier like whom? Let's name a few names so everybody has a sense of the types of players we're talking about.
Sure. Sun Life, HCC, QBE. The list is long, right? Any admitted commercial carrier.
Okay, so they're providing the insurance here,
Mhm.
and there does that mean that they are making the rules? Sort of the
That's
golden
right.
rule. They've got the gold, so they make the rules.
That's right.
Okay. But there is less work involved, less brain power required to just latch on to an existing group captive.
Yeah, I mean, I that's safe to say. I mean, there is a natural benefit to a group captive, albeit at a cost that, in our opinion, doesn't match the benefit.
Okay, and what's the benefit? Define the
Well,
benefit.
well, the do you find the benefit in a direct rider captive?
Yes. Yeah.
So you have to have a class of business that wants to subscribe to control. So in a single parent captive, they are the sole owner of a captive insurance company, and that captive will issue that policy, which means the words that are written on the policy itself are written to benefit the insured, the owner. The premiums are underwritten to benefit that insured directly. And then each month, when the insured pays stop loss premiums, those premiums are deposited into their captive, and it's an asset, right? So the employer picks up the expense, the captive picks up the asset. It's a left pocket, right pocket transaction. But
Because the single parent captive is a wholly owned subsidiary, so it's
yes,
going from the employer's right pocket into its subsidiary's left pocket, which
yes,
is its own left pocket.
yes. Now,
Okay.
lastly, in a group captive, the policy is issued by the carrier, and there's an expense load to that. That expense load conservatively is 30%, 35. I've seen as high as 45, 50% expense load. When you carve out the fronting carrier, you can get down to expense loads that are in 13, 14, 15%, which translates to the employer as an opportunity to reduce stop loss premiums or generate greater underwriting profit potential.
All right, that 30 to 50% front load, which is
Mhm.
basically it's the cost of doing business, the cost of being in the
That's right.
captive. You could call it administrative cost, all in which includes the stop loss
Mhm.
fees, right? Stop loss premiums
Yes. Yep.
versus 13, 14, 15% on the single parent. So the group captive, 30 to 50, single parent, 13, 14, 15%. Uh, but I want to go back to something you said. In a single parent captive, you said the policy, the stop loss policy or the insurance policy is written for the benefit of the employer that
Yes.
that owns the insurance company and it is being insured.
Mhm.
And the premiums are used for the benefit of that employer whose risks are being insured. In a group captive, whose interests are written into the policy?
Well, geez, the 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 stop loss carrier, hence the shareholders of that stop loss company. Yes.
So it's a question of are you paying the insurance company fees and profits, or are you the insurance company paying yourself fees and profits? Right? That's kind of how it
Yeah,
works.
that is how it works. There's a gray line there. Yes.
Okay. All right. So you're able in a single parent captive, you're able to avoid that what 15 to 35% premium. Let's call it the insurance company premium or the carrier premium because there is no fronting carrier
Yes.
in a single parent captive. How does a single parent captive function without a fronting carrier?
Well, that's a fantastic question, because a lot of times consultants will say, "Oh my goodness, I cannot touch you. Because you're not rated. You're not, my E&O will prevent me from placing your stop loss policy with my client." Well, the risk that is behind the scenes with our structure without a fronting carrier functions no differently than the risk behind the scenes of a commercial carrier. Because remember, insurance company operations are approved and regulated by the domicile regulator. So the regulator for our captive, which is in Nevada, also regulates all of the commercial carriers that do business in Nevada. So within insurance company regulation, it's not about assets necessarily. It's not about surplus. It's all about ratios. So when an insurance company is approved to issue a policy, the regulators just want to look at certain ratios that are important to the captive as well as to the carrier. So we subscribe to the same regulation as the commercial carriers do.
All right. A couple of housekeeping issues here. If you have questions, and I see some of you have already availed yourselves of the Q&A button, go ahead and submit your question now. We will get to those questions, as many of them as we can, and I might take a few along the way if they happen to be on a topic we're discussing. But go ahead and write them now while you're thinking about the question, because if you're anything like me, you'll have a great question, you'll hold it to the end, and then you will have forgotten it by the end when we take questions. So go ahead and put those in the Q&A. Just hit the Q&A button and put those in. And I want to point out that, and I should have mentioned this at the beginning, Phil, our goal here today is to show everyone in the room how you can use a captive as a tremendous tool to have a conversation, a strategic financial conversation with a CEO or a CFO, particularly the CFO, because they understand the value proposition that is inherent in this conversation even better than a CEO. But most CEOs will get it as well. This is the most strategic financial conversation you can have with a C-suite executive, bar none that I have seen. So when we give you the value prop to take forward and make a call and say, I'd like to talk to the CFO. Well, can I take a message? Yes, let him know I'd like to talk to him about blank, spell it out. You will almost always get a call back with this value proposition, and they will want to have a conversation because they've never heard about it. And when they do, the response is almost always, why would we not do that? Not always, but almost always. Why would we not do that? So I want you to stay with us because we're going to get there, but you need to understand a little bit about the structure and why this works and why it is different and why it's important. All right. So here's a great question that I do want to get to. In fact, it's two questions. The first, group captives target small to mid-sized employers. And the whole point there is safety in numbers, and you're leveraging each other's premiums. And I'll let you explain how that works, the captive layer works. But what size employer does a single parent captive make sense for? Same question. That was from Gene Casolaro. I hope I got that right. And Brian Shetter, my buddy Brian out in Arizona, said, what size group should consider the single parent captive? So what about the size constraints? And you have a great saying about this, actually.
So that great saying is, the bucket with the least rocks makes the most noise. So the simple answer to your question, Nelson, is we can create a captive with as few as 20 covered employees. Now, the common bond within our captive is not so much, the risk profile or the size of the group. It is the sophistication of the C-suite, because this is a C-suite conversation because we use terms that a group captive is unable to use. And we may get to that.
All right. So 20 is the minimum. Obviously, I think the more makes more sense because you have more lives over which you're spreading the risk. You have more premium over which you're spreading the risk. I think that's basically the point.
Yeah, it comes to a group of 20 employees may have a stop loss premium of $80,000. And if they have a fantastic year, they're going to walk away with 60,000. Well, I mean, is that exciting? It could be. But if you have a 400, 600, 1,000, 2,000, 3,000 life group, you're going to walk away with hundreds of thousands of dollars a year. And that's exciting.
Yes, but you know what? I'm gonna respond back to you on that, Phil. When you're a smaller company, 100,000 is exciting, right? You know, 600,000 is exciting for anybody, but a bigger company, sure, but 100,000 for a small company, I think I think the idea is if you have a smaller company, and Bill Hughes recently put what about a 50 to 75 life group
Yep.
in the Ultimate Captive, and it was a wastewater treatment company out of Texas. And you know, that's not 600 lives, that's 60, 70 lives. So you start with what you've got as in a group size, but this conversation will get you in the door to much larger groups. You can get to a CFO of a 500 life group with the single parent captive conversation. And that may be well out of your comfort zone. So have it with a 200 life company and talk to the CFO there. The point is, this will open doors to the C-suite for this conversation, and then you can work your way up the size ladder. But
Right.
there are an awful lot of 50 and 75 life groups out there.
Absolutely.
And we don't want to ignore those. But the risk is greater for smaller groups that they're going to, you know, one bad cancer or bad car wreck, one preemie baby can really put a hurt on a small group that's self-funded at all. Captive makes it a little
Yep.
bit easier, actually. All right,
But
so
now,
let's go ahead.
but now just real quick, but we do cap that smaller employer's exposure, right? We have a risk pooling element. We do buy excess coverage, so we cap our maximum exposure. So even a 50 life group can go into this structure with a full unit cost analysis of what their maximum liability is going to be, just like a group captive.
Well, just like self-funded. I mean, you're
That's
going to
right.
go in you're going to establish your own maximum liability. The
That's
question
right.
is, does your tolerance, does the max liability that you are willing to tolerate, is it high enough that it's cost effective
That's
to
right.
leave fully insured to go self-insured? I mean, if you want a $20,000 spec, your stop loss could be pretty expensive. It's hard to imagine you're going to be able to beat a fully insured plan at that
Exactly.
point. All right, so let's talk about the process. So the employer is told by the insurance company, which it's your actuaries who determine the risk level and the premium required to cover that risk.
Yep.
They get that number, they put that money into their captive insurance company. What happens then?
Well, it sits there. So they're captive, and a very simple, concept of is a savings account. So the employer is going to expense the stop loss premiums, just call it $10,000. That $10,000 is deposited into their captive, where now it's a cash asset, and it sits there. And it sits there until they have a stop loss claim. And the way our structure works is the client's claims are paid by their captive first. So it functions like a FIFO inventory accounting methodology, first in, first out. So if a client has claims that exceed the cash balance in their captive for that policy year, that's when the other captives step in and subsidize the claims loss for that particular policy year for that client.
So this goes, there's a question here that I want to ask, because I think we just answered it. What's the difference between simply a single parent captive versus simply self-funding?
Well, so if you're simply self-funding, you're buying a commercial stop loss policy. Or is the question saying, I don't want to buy any insurance policy? And sure, you can do that, but there are balance sheets and liability and tax deductibility losses, missed opportunities to have if you didn't buy any stop loss coverage, which is a whole separate conversation.
Same person asking the question is earlier part of it. I'm going to give you this. My understanding of a group captive is that risks are pooled and they have purchasing power. Are those positives not present with a single parent captive?
Well, purchasing power is a very broad and propagandist type of label. If I were to say purchasing power on the stop loss, I would suggest that you reach out to the shareholders and see what the management is giving up on the per policy profits that are given up, right? I don't think there is any economies of scale from the stop loss carrier to the policyholders. What there may be some economies of scale are health plan service providers. So if a captive program manager reaches out to a health plan service provider, such as a TPA, and says, we can make you our recommended TPA, and for that recommendation, we want to issue a 10% discount on TPA services when we bring business to you. I think that's a real possibility. I do not think the issuance of a stop loss policy is an economies of scale that is merits discussion.
Well, it certainly doesn't between a group captive and the single parent captive, because we've already established there's a 15 to 35% variance
Correct.
between
So
the admin cost or the front load cost of a group captive versus a single parent captive.
Just remember this too. Care and feeding, not only is it held at the stop loss carrier side, but the captive itself has its own expenses. The captive's expenses and the carrier's expenses negate, in my opinion, and from experience, any concessions that were had from the stop loss carrier.
Well, I guess the end of the day, the proof of the pudding is in the taste, goes the old saying.
Of course.
So because what you're looking at, why are you in a captive? Why is an employer in a captive? Why are they self-funded? And then why are they in a captive? And the idea is we're going to do a better job of controlling our costs and reducing our spend, self-funded in a captive, than we would if we were fully insured. And the idea behind the captive, in part, is the captive layer, which is the risk pool of the combined premiums of all of the members of the captive, eliminates the need for that much stop loss insurance. Right? You are self-insuring, as it were, that level. So let's say, what's the cap? What's the captive layers top level?
So $750,000 for 2024. Next year it'll be $1 million.
Okay. So right now, $750,000 is covered by the captive layer without having to use stop loss, which means you're buying stop loss at a $750,000 spec. Is that, am I getting that right?
No, I mean, there's an element of truth to that. Yes. And that cost to our members is next to nothing.
Because very rarely are you going to pierce a $750,000 stop loss ceiling. So
That's right.
so what you're doing here is you're economizing. You want to talk about economizing on stop loss. You're economizing on stop loss because the captive layer here is able to absorb so much of the risk. I'm
That's
saying
entirely
that.
right. Yep.
So you don't have to go to the excess market until you hit $750,000 in cost for a single company.
Yep.
Correct?
Yep.
All right.
And
So you've got savings on the front end. So which means there's more premium available for claims, that
yes.
money that doesn't go to the captive or the fronting carrier is available for claims. So we've got an example. I really should pull it up here. That shows. I think I will pull it up actually. I'm gonna get you talking, and I'll pull it up. But it shows an actual example of a group captive versus the single parent captive, same scenario, and the impact of that front load cost on premium available to pay claims, so that at the end of the year, you have much more underwriting profit, unspent
Yes.
claims dollars in the single
Yep.
parent captive, because you had so much more claims dollars available, even though the premium is the same, the entry premium is the same. The cost of running the captive, the cost of the captive was so much less, 35%
Yep.
less this particular instance.
The care and feeding of the operations of a captive, that's an expense that can't be missed. And frankly, if you're a consultant, how do you judge or benchmark those expenses without getting your hands on the core documents? If you're looking at vetting out a reinsurance captive, which is a group captive that's fronted by a carrier, you need to get your hands on the bordereau report. If you don't, game over, man. The bordereau
All right,
report
this
is vital.
sounds like you're talking about a fellow I met in New Orleans once, a Louisiana gentleman named Boudreaux. You want to explain what you're talking about there?
Yep. So the bordereau report is the accounting between the fronting carrier and the captive. Because remember, the captive has its own financial statements that it must report to the regulator. But when you join a group captive, when you pay your premiums, those premiums go to the carrier. They do not go to the captive generally. So the carrier collects the $10,000, and then they take out their expenses, and that boils down to, $7. That $7 is now the top line revenue of the captive for its financial statements. So the bordereau report is where the consultant will be able to see where all of the expenses are within a fronted captive arrangement. So if you want the details, you need the bordereau report. It's that easy.
And so all they have to do is ask Berkeley or Pareto or Roundstone for the bordereau report, and they'll get it.
We'll see, the Zen master says. Usually that's a more challenging document to get, and we'll just keep it at that.
What about with Ultimate Captive?
So with Ultimate Captive, there's no bordereau report because we don't have a fronting carrier. However, each captive gets their own financial statements, and then each captive participates in a risk pool with other captives, and they can see how the performance of the captive as it participates in the risk pool. So they see everyone else's losses, and they get to see 100% of where that 13 or 14% expense load goes. Selfishly, as the captive manager, I'm taking roughly 8 to 9%, and the excess carrier is taking 5% or so of the premium. So when you add those two numbers up, that's the expense load. Now remember, my captive management services go beyond that of a group captive, because my office does the underwriting, we issue the policies, we submit the policies to the regulator, we do all the accounting, we pay all the claims. So we're doing all of the duties of the fronting carrier, but we're doing it for about 8 or 9%.
All right. I'm going to share something and we're going to walk through this real quick. We call this a tale of two captives, comparing a traditional group captive with an 831B single parent captive. So the traditional group captive is a rent-a-captive. You rent a hotel room in the hotel. In the single parent captive, you're buying the condo, as we talked about before. So this is an actual Berkeley captive case, and we're going to compare it to what the numbers would be in a single parent captive. In this case, the ultimate captive, the next gen ultimate captive. All right, so you'll notice at the top that the premiums are identical and the losses are identical because it's the same group, right? What only thing that changes is what happens between the time the premium is put into the captive and the losses are taken out of the captive. So Phil, let's look at expenses here. The total expense load on the group captive is 49.78%. You can't get much closer to 50% than that. On the single parent captive, it's less than 14%. Where's the difference?
Mm-hmm. Well, the difference is, the underwriting fees. Okay, so the underwriting fees are usually paid to the stop loss carrier for the fronting services, the administration services, and so forth. And the fronting fees of a fronted captive, the fronting fees are charged by the commercial carrier. The fronting fees are generally the loss leader. And what happens is the fronting company will work with the captive and say, we'll front for you, but you have to purchase the excess reinsurance from us. And generally, from experience, that's where the loss leading fronting services, the excess reinsurance, is where they make up their revenue, because the excess is the floating high severity stuff, okay? The really big claims. With Ultimate Captive, we can go out to the excess reinsurance markets every single year if we want. So there's a lot more competition, and it's a lot more efficient when you go direct with a excess carrier. So this is where we make up a lot of our savings here. So when you add up all of these fees, you generate a much less expense load than you do with a fronting arrangement.
Okay. All right. Now notice that after the total expense load has been paid, you have in the group captive basically half of the premium that was placed into the captive to pay claims. The purpose of your premium is to pay claims, not to enrich an insurance company. But on the single parent captive, the ultimate captive, you've got almost 72% more premium than is available in the group captive to pay claims. But if you look and see, it's 1.8 million out of 2 million that you put in. So it's a remarkably higher number available to cover losses. Once you have paid those losses, and again, it's the same in both scenarios because it's the same case we're looking at. In the group captive, the claims have exhausted the available premium to pay claims. So you have basically broken even for the year. You have no underwriting profits or excess premium that was unavailable, excess claims dollars. Underwriting profits in the single parent captive is over $700,000 in this case because it wasn't eaten up by the carrier, by the fronting load.
Yep. It's just a more efficient model, so.
And so, but boil down, when you're spending half of your premium on expense load it's going to eat up a lot of premium that otherwise could drop to the bottom line as capital reserves or unspent claims dollars. But this we'll get to this in a minute. Actually, let's do this now. Let's talk about the tax advantages of a single parent captive versus a group captive, because I think that's go ahead.
So this is where every captive has to file a tax return, and that tax return is filed on Form 1120 PC. And on top of that form, there's an option for captives that qualify to file as an 831B captive. Now, filing as an 831B captive, if you're eligible, that allows you to not pay income tax. Now, currently, 21% is the income tax rate for C corporations, which all captives are. So this gives you some motivation for the employer to accumulate an asset in your captive, be exceptional in your risk control motivation. Your risk controls trying to do the right thing, controlling costs, because at the end of the year, you have a tax efficiency. Now, this is not the motivation to do this, but it's a very powerful motivator for an individual company to have a greater efficiency. The downfall of a group captive is generally they don't qualify for the 831B election. So therefore, they have to pay income tax on the underwriting profits. And then if that group captive issues a distribution to the members, so, hey, Nelson, you did fantastic in this group captive. Here's $100,000 of underwriting profit for you. Well, guess what? Now you've got to pay 21% long-term capital gains on that $100,000. So you can achieve some tax efficiency through the 831B election, but that's just the powerful motivator for everyone in the risk pool to actively control risk. And that's what you want. If you're going to swim in a risk pool, you want people to be greedy, right? You know, Wall Street, I love the Wall Street. Gordon Gekko, greed is good. When you're in a risk pool, you want people to be caring about how claims are paid. That's what we focus on.
So just to illustrate what you're talking about, let's say at the end of the year, there's $100,000 in unspent claims dollars. You're in a group captive, that $100,000 is going to be deducted $21,000 because the group captive has to pay the income tax on it before they give it to you. That means that $79,000 comes back to the employer in the group captive. The full 100,000 is returned to the employer in the single parent captive. So you can see the difference there. You're already ahead of the game as a single parent captive owner. But then, go ahead.
So just to be clear, that $100,000 isn't taxed if it stays into the captive, right?
No, if it's distributed, right? We're talking about if it's distributed, right?
If it's distributed to the employer, then yes, it's taxed at long-term capital gains. But if it stays in their single parent captive, it does not pay those long-term capital gains because they're not distributed.
Oh, that's right. And that's what the screen is showing.
Yes.
Right. So it's only if they're returned and you're not in a captive do you pay the long-term capital gains. So the difference at the end of the day in a group captive, you end up with 62% of your $100,000. In a single parent captive, you end up with 100% of your $100,000.
And Nelson, this is very powerful because this is called financial statement consolidation. The employer is the sole owner of a single parent captive. They own 100% of it. So all of the profits are consolidated through the corporation's balance sheet and the captive's balance sheet. You just can't achieve that with a group captive because no one owns more than 51%.
All right. Let's get a couple of questions here. And by the way, let me add, because of the part that we just showed you, this part right here, and the fact that there is no tax paid on that underwriting profit until it's taken as a distribution by the employer out of their captive, it sits in their captive and it's invested like any other fund company would have, that with money sitting in it, and it accumulates tax deferred until there is a distribution, and the employer can borrow against the funds in their captive and pay themselves interest instead of going to a bank or some other lending organization. So this is why this is such a powerful conversation for a CFO in particular, or a CEO. Here's the best part, though, for those of you who are doing next gen, having next gen conversations and trying to get that executive to pay attention to their healthcare spend. All of a sudden, if they buy into the single parent captive concept and they understand that the goal is asset accumulation, they become very interested in what you as their advisor are doing to contain cost, to mitigate cost, and to drive as much of their premium back into the captive as underwriting profit. And that's one of the biggest challenges I know you all deal with, is getting the CEO, CFO says, well, I don't care. There's nothing I can do about healthcare. I don't care. I don't understand healthcare. When they see asset accumulation like this and it's happening tax deferred, they get very interested in how they can manage their healthcare spend. Phil, you've seen that over and over.
Yep. It's what's in it for me, right? Every employer makes every buying decision, not for the kumbaya, let me join a group captive because I can go to these meetings offshore or onshore or whatever. What is the best bang for my buck? And the single parent captive isolates their interests, and only when their peers are there to backstop their risk, but it is them accumulating their own assets.
All right, some good questions. Isn't the risk much greater? That is, the member retention of risk much higher in a direct writer than with a fronting carrier?
No. So the captives are participating in a risk pool, just like the group captive members are doing. So the risk pooling protects the employer against losing more than what the premiums that they paid in, just like a group captive. No different.
All right, so there is no greater risk.
There is no greater risk.
Okay. All right, let's see. We've answered that. What's the difference between a captive and a consortium?
Oh boy. Well, I'm not sure I have the proper background to answer that question. But a consortium I've always viewed as just a group of employers going to the marketplace to purchase something. So to some degree, this is like a consortium, but it's more individualized than a consortium.
Okay. And yeah, and I don't think a consortium is about sharing risk. I think a consortium is about aggregating buying power.
Generally, yes.
It's generally a volume. You see it in pharmacy a lot. Pharmacy consortiums. Although I will tell you that when you're talking to employers, while you have to talk about a single parent captive here eventually, you can we have clients who use the term, it's not consortium, I'll give you a second, I'll think of it. Just fled my mind. Debbie Ryder, who was formerly a corporate consultant, asked a good question. If 20 is the minimum, is there an optimum size for a group in a single parent captive?
there's no real optimum. We see a lot of excitement when employers are 100, 200, 500 size groups.
Okay. Where does the insurance company, a subsidiary of the employer, get the money to fund a catastrophic claim? That's the excess above
Yeah.
some.
So the way it works is your client, the employer, is going to pay $100 into their captive as premium. We're going to take about $5 of that and purchase excess coverage. What remains after expenses for me, $85, let's say. That $85 will sit into their captive. If they have a $500 claim, well, that $85 comes out. The other $415 is then shifted and shared and allocated to the other captives in the risk pool, just like a traditional carrier.
All right. Two questions similar. How are capitalization requirements determined in a single parent captive? And is there an equity commitment required? Same question. So what about collateral?
Well, we don't have a fronting carrier, so there's no collateral, but there is capital. So capital is a function of the premium. That capital is deposited into your captive. It's the insured's basis into their investment that flows to equity. So if you deposit $50,000 of capital, cash equity, when you consolidate your balance sheets, you pick up the equity on the other side. So it's a net zero allocation of cash.
Because it's your company, so it's still your
Yeah,
cash.
that's right. That's right.
It's just on a different balance sheet until you combine the two to go to the bank or
and
another lender.
What's horrible about collateral is not a deductible expense of the employer. So if they have to pay $100,000 of collateral to a carrier, they're paying income tax on that collateral.
Yes. No, Jim, we don't. This will probably be the last time they show up. Good question. Thanks for pointing it out, and thanks for being with us. Let's see. What percentage of the premium? How's that? How is capital determined? They're going to ask me.
Well, the right answer is a 4-to-1 premium to surplus. So if your premium is 200 grand, it'll be $40,000 thereabouts.
Okay. Let's see. Mike Murphy has a question. What is the value of running the claims through a first layer captive owned by the employer versus just taking on the protection of the second layer? For example, company A has an owned captive insurer layer of say 500,000, after which the secondary captive takes the risk. Why bother with setting up the single owner captive and just take the excess layer and truly self-insure the first layer?
Well, you're losing a tax deduction equal to the amount of reserve that you have to put into your balance sheet. So in other words, if you just want to buy a high level catastrophic policy, if you have a large claim under that really high policy, you've got to reserve that on your balance sheet as a liability. And when you're doing that, you're adding liability exposure and you're reducing a tax deduction equal to the premiums that you're not paying anybody. So there's a two-layer motivation of why employers do this. They want the deduction.
All right. Let's see. Good question from Nick Lees. Can groups use the concept to start building pooling for specific risks, for instance, dialysis, transplant, air ambulance, et cetera?
Sure. Easy peasy.
All right. And let's see. Nick has another question. Can a client continue to roll excess premiums year to year to build a reserve and subsequently be able to raise the entry point of the excess loss carrier layer?
Yes. So the risk pool is the purchaser of the excess policy. As the risk pool develops and increases its critical mass, we increase our retention with the commercial carrier. So yes, with growth, we take on more risk.
All right, great. Is there a difference in optimum size, group size, when considering California's self-funded rules? That's from Cheryl Benjamin. Thanks, Cheryl.
That's a very complex answer. Generally, self-funding when you're competing in a Kaiser market has not been proven to be successful for us. So I'm going to be squeamish to go into that market, period. But was the main question size?
Yes, group size.
You know,
Well, the rules in California basically are the $40,000 minimum spec. I think that's probably the operative
so
rule.
here's the official answer to this is the stop loss policy is what's called a non-admitted carrier. Therefore, non-admitted carriers do not subscribe to or have to comply with the insurance commissioners in the 49 other states. So that's a much more complex question to answer than I probably shouldn't answer on this call.
Okay, fair enough. Let's see. Can some of the underwriting profit be used to provide incentive for employees? If so, what would be the tax consequence, of any?
If they earned underwriting profit in 2024 of 100 grand, if they take out a distribution of that 100 grand, yes, it's going to be taxed at long-term capital gains. They can use that 79,000 for whatever they want. If they want to take out a loan against their captive for that 100,000, 100,000 can be taken out. They can do whatever they want with that 100,000. But yes, you can apply that the underwriting profits however they want.
Okay. Greg Stefanik asks a great question. Do you use the single parent captive discussion to help convince employers to go self-funded? You could. It's going to be a lot easier with an employer who is already self-funded because you don't have to push the boulder up that hill and convince them that it's safe to go self-funded. But you certainly could. If they're a larger group, they should be self-funded anyway. 200 or up, 250 or up. I call fully insured groups that size an example of medical malpractice by the broker. Let's see. So yes, you can, but I think the easiest is a group that's already in a captive. It's like the old A.L. Williams buy term, invest the rest. The client already had a whole life policy. You weren't selling them life insurance. They'd already made that decision. You're simply showing them a more efficient way to do life insurance. Is underwriting gain returned to member taxable? The answer is no, as long as it stays in the single parent captive.
Yeah. So if they take a distribution, it is taxed at long-term capital gains. If they take out a loan, which you can do that, that loan has to be repaid, but it does not come out as a taxable event.
And it said distributed to the member. I was assuming back from the captive facility after the end of the claims year. That's no tax until it's
correct. It is not taxable.
Yeah.
Yes.
Let's see here. What other great questions? Startup cost to an employer to form the subsidiary. We touched on that in terms of capital required.
Well, so the capital, yes, and there's also an application fee. It's a mere $300, but that gets you the application to Nevada.
Okay. And by the way, is the buy-in, this is for my benefit, Jay probably already has the answer to this, Jay Torres. Hey, Jay, what is the typical buy-in for a group captive? Is it similar to a workers' comp captive?
Oh, boy. So a lot of times collateral and capital are blurred together. So from experience, the collateralization, let's say, is 50 grand, but the carrier only requires 40. Therefore, 10,000 is held back by the captive as capital.
Okay. Another quick question. Are legal services required in the formation of the insurance company?
No, it's all part of the application fee. There's no
Okay.
cost to start this up.
And last question from Nick Leese again. Is there any concern that employee premiums are being utilized to capitalize the captive and therefore would need to be earmarked for employee benefits in the event of excess?
Well, that's a good question. So there is a stipulation, and you have to sign an attestation agreement that only employer dollars are used to buy stop loss premiums. So you can't payroll withhold into an account and then pay your stop loss premiums from that account.
All right. Well, we are just a minute or two over. So, Phil, I'm going to let you hit the road, but thank
Well,
you
thank you.
very much. I think this has been extremely helpful in illustrating the fact that there are different types of captives, and there are times for a group captive, and there are times for
Yep.
a single parent captive. But the conversation itself is such a door opener for you as an advisor to get into that CEO or CFO when you can say to them, would you be interested in hearing how you can turn an operating expense, your healthcare spend, into an asset?
Yep.
It's like, I don't know what you're talking about. I have to find out what you're referring to. And
Yes.
then we bring Phil in to have the conversation. You do not have to become an expert on single parent cat. In fact, I urge you not to try to be an expert on single parent
No.
captives. Let the expert be the expert. You be the consultant who brings in the expert. But a great
That's
door
right.
opener. If you have more questions, you can reach me at Nelson at nextgenbenefits.com. If you want to have conversation about this on the ultimate captive, which currently is available to next gen advisors who are involved in our next gen benefits mastermind partnership group or in our mastery track program. So if you have any interest, then just give me a buzz. But the ultimate captive is in fact exactly that. It is the ultimate captive, in my opinion, for employers who want to maximize cost savings and maximize assets. All right,
That's
Phil,
it.
thanks much. I
Well,
think,
thank you.
Kendall, who do we have next week, next month in the lounge?
Kristen Dickerson.
Dr.
Oh,
Dickerson from Green Imaging. That will be a great conversation. She's got some new information around avoiding the problem with an HSA and first dollar payments like from Green Imaging. She's got some workarounds on that. So don't miss that. Talking about how the Green Imaging's model, basically direct contracting with diagnostic imaging centers, is changing the game and saving employers tremendous amounts of money and saving the employees 100% of their out of pocket for that diagnostic imaging. So that's next month on the Healthcare Lounge. Phil, safe travels, and everyone else, have a fantastic
thank you.
rest of the week. Take care.